Hi guys, Stanley here. Singapore Airlines has to be one of the worst hit stock right now in Singapore. So, is SIA a good buy right now? Let's find out. 2020 has not been a great year for airlines. Singapore Airlines has cut 96% of its capacity right now, and it has grounded all its fleet. All this because of the COVID-19 pandemic. Its share price has dropped about 40% since the beginning of the year, and its main shareholder Temasek has come out and promised to save the company by helping it raise $15 billion. Many of their staff is enduring a salary cut right now. However, at the end of last year, the bank do have more than 1.7 billion Sing dollar in its bank. But that amount would only last the company for a couple of months. So there was a real chance that Singapore Airlines could not survive this crisis. And that is why that they have to start raising money right now. And they're raising big. On the 27th March, the company announced that it wants to raise $15 billion from investors. That's a $5.3 billion from rights issue and another $9.7 billion coming from a convertible bond as well. And this whole fundraising will be underwritten, that means supported by its main shareholder, Temasek. In addition to that, Singapore Airlines is also raising another $4 billion from a loan from DBS. So there's a total of $19 billion coming to save a $7 billion company. I can definitely say that the worst is over for SIA and it should be able to survive the crisis right now. However, what is good for the company might not always be good for the shareholders. For one, if you're now a shareholder of Singapore Airlines and you choose not to subscribe to the rights, your shares will actually be diluted. It will be diluted by 60%. This means that if you own 10% of the company right now, you will end up only owning 4% of the company after the rights issue. And that's even before the conversion of the convertible bond, which will mature and might be converted in 10 years' time. This means that there is a huge dilution risk for investors unless you choose to subscribe to both the rights issue and also the convertible bond. When it comes to investing, the first thing that investors tend to learn is that we need to buy low and sell high. Singapore Airlines share is trading lower than normal right now, and it seems like a bargain. But what investors tend to forget that we must also invest in companies with good long-term prospect. This is because if the prospect of the company is weak, even though you are investing into the company at a cheap price, it's still like getting on a train that is rolling downhill. So does Singapore Airlines has a good long-term prospect? In my opinion, not really. The company struggles to grow its business for the past decade. Its earnings actually peaked in 2011 and has never recovered to that level before. And it's a capital-intensive business, a very capital-intensive business, which has sucked more cash out of the company than it has brought in over the past 5 years. To me, Singapore Airlines is a stock that is offering more risk than reward for investors, and this is one that I would personally not invest in. But Singapore Airlines is an important company to Singapore and definitely need to be safe at all costs. It is the bloodline that brings in more commerce and more tourists for Singapore, and that's why it is very valuable to the Singapore economy. Unfortunately though, a company that brings great value to society might not necessarily bring great value to investors. But if you're looking for companies that might bring great return for investors, check out our dividend stock guide where we're gonna analyze 5 dividend companies for you. And what other companies do you like us to analyze for you? Comment down below and let us know. That's it from me. Till we meet again, my name is Stanley. Invest safely.